Welcome to our episode 19 of our Tuesday night podcast. And tonight we're talking about how to boost your credit score so that you can get the best home mortgage rate. And so tonight, home buyers, this one's for you. We're with Alisa Glutz. She is an author of a book called Color My Credit. And she also has an online course called Color My Credit. And in her spare time, she's a full-time loan officer. So if you're in California or in Arizona, where she's actually located, you have to reach out and let her give you a quote on a home mortgage. And I'm Todd Sachs. I'm a broker here in Maryland. I help buyers and sellers of both commercial and residential real estate. And if you're anywhere other than Maryland in the United States and you don't have an agent, you can reach out to me. I'd love to know what you're working towards, and I can help you with one of our amazing referral agents that we have located all throughout the country. So tonight we're going to talk about 5 great tips to improve your credit score. And without further ado, let's go ahead and meet Alisa. Alisa, thanks so much for joining us tonight, and fill in the gaps.
Yeah, you did a really good job. I think you covered everything. Sometimes I square dance on the weekends. I do learn my little renegade, TikTok dances from my little girls. So I have 2 little girls as well. But yeah, I think you pretty much covered it. I've been a lender for 18 years and I'm licensed in Arizona and California. Mortgages are my expertise, but credit is probably is my darling. Credit's that thing that I could probably read and study about all day long and never get sick of it. And I have no idea why. I looked at God one day and said, oh, talking about credit? Are you serious? But anyway, he put it on me to make it more simple, more fun, more interesting, because it is going to be one of the biggest things that's going to help you with building a financial legacy. And we don't understand it. We feel it's complicated. We feel it's overwhelming, or that it's not fixable. And I'm here to show you you're totally wrong about that. And we can make it easier. Bring hope back in your life.
Yeah, a lot of people don't realize. It's like the most important step in buying a home. So, if your credit score is low, there are certain things, and we're going to talk about that tonight, that they can do to actually boost it. And it really affects how much they pay for a house on the long term. So
it does.
And having that lower interest rate is definitely going to help them as far as how much they can afford to buy and what they pay for that house over the term of the loan.
That's the truth.
So a lot of people don't realize it's FICO score is like the most important one. I know there's an Advantage, I think, score okay. So a lot of people, and that's Credit Karma. So many buyers are checking their score on Credit Karma. And can you kind of give the difference of the two?
So when you go to Credit Karma, that is a website that offers you a Vantage score, but they're not one and the same. Vantage score is also offered if you go directly to transunion.com. They give you a Vantage score. Equifax.com, they give you a Vantage score. CreditWise, Chase Credit Journey. Most of the scores that are given to you for free these days are Vantage score. Vantage score was created by the 3 credit bureaus to compete with FICO. FICO was the industry standard for 35 years. And then in 2006 is when the 3 credit bureaus created Vantage score, this new scoring model that was going to be more beneficial for consumers. And it all sounds good, except no lenders, none of the banks, nobody got on board. It failed miserably. So nobody uses Vantage score to this day as a tool to see if you get qualified. But it is the most freely given score out there. And beyond the fact that it looks like a duck and it sounds like a duck, it's not a duck. So the range of numbers is between 350 and 850. It's grading the content of the report. It just has a very different grading system. And a lot of the stuff, the content is invisible to Vantage score to benefit consumers, but it isn't to FICO. And not only that, the FICO versions, there's many, many FICO versions. Most people don't have access for free to a mortgage FICO score. So they're looking at a FICO 8 or a 9 model. And so you have to look a little deeper. Whenever a score is given to you, you have to understand what bureau gave it to you, what model are they using, and what version of that model. If I called you up, Todd, and said, well, the score was 14.2. Would that be enough for you? No, you would want to know, what sport, what team, what year. Same thing. If you tell me a credit score, I need to know what bureau, what model, what version. or it's all going to be very different. And it might be a version that nobody cares about, that you're following and you're educating yourself on, and nobody uses that score.
So what's a good score? I mean, so what's the range?
Yeah, 350 to 850. There's many different models. There's some models that go as high as 950. Okay. And a lot of them start out in the 300, 350 range. However, 90% of America is above a 470, just so you know. So you don't start at 0 when you turn 18. It all depends on if you have credit reporting. A lot of people will call me and say, my kid turned 18. They have no credit score. You don't just get one. You got to the whole thing about a score, remember in your head, is it's your way of demonstrating you're good for it. If you were to borrow money, this is the way you demonstrate your low risk. How would you do that? If I showed up at your house, Todd, and said, I want 100,000 and you didn't know me from anyone, would you give it to me? No. Even if you had the money, you would probably say, can I call one of your friends? Have you ever done this before? So the fastest way you can improve that credit score is to really focus in on what information is reporting and how you're demonstrating that you could have borrowed more, but you didn't. Low risk. So we'll get into that a little bit more. But yeah, the FICO score, it's so key to understand that how it fits into every piece of your mortgage, your home insurance, car loans now, your car insurance, how much you pay for a cell phone deposit, utility deposit, getting a job. I mean, there's so many different ways that credit's being pulled in. So it's affecting more of our budget than ever.
So to get a home mortgage, is there a minimum score that you must have regardless of the interest rate?
Right.
Is there a base score that you need to be above before you can even qualify?
Yes. And that's changed a lot with COVID, where we used to, it was a very universal and everybody understood, you could go down to 580, with most FHA loans. Okay. Now, I mean, really, we just got moved down to 640 is really across the country. You're going to see some people doing 620s. But that's just right now we're at 640. If you have a down payment, if you don't have down payment, you need down payment assistance, we might need a 660, but that's just to get you in the door. Then you have to remember that when you go from 640 to 660 to 680 to 700, every 20 points is going to change the interest rate and change the mortgage insurance if you're not putting 20% down. So a FICO at 670 versus 740 on a $250,000 house with the minimum down, that's a $400 difference in the monthly payment. That's a car loan that when you think about it, like you being able to add on that 400 extra onto your house payment every month, you'll also get the house paid off half the time. So it's all about, making your money work for you, leveraging, using that credit score. But yeah, most mortgage companies want to see a 640 right now. And then it's going to be, well, what's that payment look like on the house you want with the 640? Oh, you only qualify for here? Well, then we got to get you to a 740 so that house can be affordable for you.
Gotcha. So what you've seen then in the last year is actually it's becoming more difficult, or your credit score has to be higher to even qualify, even at the highest interest rate.
Well, the thing is that what happened before was you could almost get in the door to buy a home if you didn't have an open credit card reporting, because you could still reach a 580 credit score and not have an open credit card. The minute you have an open credit card, it's like getting flour in the bowl trying to make a cake. It's like suddenly it's working. Okay, so the credit card just reporting $20 a month, that one little simple move will give you the ability, no matter what's on your credit, collections, charge-offs, whatever, to get up into that 620, 640 range without even having to pay the collections or charge-offs off, without even having to settle that stuff. But if you don't establish some new good credit, then you're going to miss out on being able to reach above that 580 mark. And so right now you got to get there, in order to get just in the door to qualify.
So what you're just explaining, you're talking about raising your credit score by having a credit card,
just an open revolving account that they can review.
So if you look at like a credit score of 700 or any credit score, really, what percentages make up how's the debt calculated? So is it, I think I had heard you say one time that credit cards account for 15% of your score?
30.
Is that 30%
of it?
Okay.
Yeah,
All
for
right.
FICO. So Vantage Score, if you're looking at Vantage Score, it's going to be very different. They don't care about utilization the same way FICO does.
If
But
they're,
FICO, it's a big deal. And
yeah,
people get confused because they'll see 30% of my credit score of the pie chart, is what is the credit utilization. But all the websites out there will give you a total utilization. So they'll add up all the credit card balances and all of the limits and give you a utilization based on that. And that's not how FICO does it. FICO does each individual revolving account you have. It's looking at what was available to you. What was your allowance? What was the credit limit? What did they report you used? And that's a key thing. You have to know the day they report. It's not the day your due date. It's not your cycling date. It's not the day you paid your bill. It's the day they want to tell them. So you got to get that on track with that, because the amount they report is going to factor in, like we said, 30% of your score for the month.
gotcha.
Only behind paying bills on time. So
Yeah.
it is really like the next
Wow.
step. Once you're paying your bills on time, that won't be enough.
Yeah.
Then it's going to be looking at each individual credit card.
Yeah, well, let's dive right in. So tip one is establishing credit. So I know a lot of, millennials
Yeah.
actually made up over 30% in 2019. And I'm sure the numbers when they come out are going to reflect a very similar percentage. So a millennial is accounting for like a third of the home sales across
Yeah.
the country.
I believe
And,
it.
I don't have to do the calculations for you. These are young people that are in a lot of cases, new to the workforce and freshly graduating college or, and they don't have any credit to speak of. So let's talk about how someone can start to establish credit.
Right. So it really depends on whether they're building for the first time or rebuilding the way they want to go. If you're building for the first time, Discover's a great place to start. Discover Scorecard. And you can actually go to Discover. You can go to creditscorecard.com and get a free FICO Experian. It's an Experian score, FICO 8. It's the same score Experian would give you if you went directly there, but they give it to you for free even as a non-card holder, just to get an idea. But that's a great card to start out with if you're young. And the key about it is that you're going to get this credit card so that you have something that is working for you and you're not working for it. So that credit card gets put into action. It becomes the payment method for something that's $20 a month. I'm sure you have something. There's a $20 Netflix. There's a $20 gym membership, something. That $20 a month is what gets charged on the card. And then after they report for the month, you pay it to zero. It's like lather, rinse, repeat, just like shampooing. Every month you do one $20 charge. And the thing is it doesn't matter if the limit on the card is 200 or 500 or whatever the limit is, you just drop the last digit. That's your real limit. That's your real limit so that you don't get yourself in trouble. That's equal to 10%, which is different from every website out there. They're going to tell you, well, 20 to 30% is what's. No, it's not. Do you want to be good or do you want to be great? Let's just talk about it. Do you want to be good or do you want to be great? So 10% is where you need to be. What that balance needs to be reporting every month, because what that demonstrates is that you are low risk. You had a choice that month. You could have borrowed 200. You borrowed 20. It wasn't zero. Zero actually looks like you're not playing the game. You ever see that commercial for Pringles and it says no one can eat just one? Well, no one can eat not. If you abstain, that's not as hard as eating one Pringle and then not eating another one. So the point of all of that visual Pringles, now I'm hungry, is that one credit card, that's all you need. You don't need to go open multiple cards. You need one card that you borrowed 20 out of 200, 20 out of 500, 20. You ate one bite. That's it. And then you abstain from going back. So that demonstrates low risk. And that's really for someone building or rebuilding. It's just what card you start with if you're building or rebuilding, Discover or Open Sky. And I'll talk about that in a minute. But the second thing I would like you to do if you're just starting out building credit is you need a good mix of credit. One account reporting is going to take 6 months before a FICO will be generated. You need 6 months of an account reporting before a FICO score will be generated. But even at that point, to buy a home, if you want to go with a conventional loan, not FHA, you have to have 2 trade lines. You can't just have one. So you got to have one credit card. The other account I want you to look into, because I don't want you to go into debt to have a good credit score. No need to. So the $20 is the payment method for one of your Netflix or something. The second account is called selflender.com. And it's a savings account. It's like layaway for your money. And you commit to $25 a month. They take the money from your bank account once a month and report to all 3 credit bureaus you made your payment on time. And at the end of the 24-month term, you get about $560. So that money just adds up every month. You can do the one I did, which was $91. And at the end of 1 year, it was $1,000. I do it every single year for the last 4 years. So I love getting the check at the end of the year for $1,000. And all along the way, I built credit while savings. Like what, you can always have that in the background. It's equivalent to like a car loan. It's an installment loan. So just that, really, one credit card and one installment is all you need to set up your system and have it work for you right from the beginning. That will generate an 800 score in the fastest amount of time.
So what is the minimum amount of time, if you were looking to buy a home in the spring of 2021 and you have
no credit,
you don't have any credit cards, can you say it takes 6 months? So is that the minimum amount of time?
That's if they have no credit at all. Then they need 6 months of an account reporting before FICO will generate. Now, Vantage Score will generate after 1 month, so it'll get confusing. You'll see, what is she talking about? I've seen my Credit Karma score. That's a Vantage Score. It takes 1 month to generate her score, but nobody uses Vantage Scores. That's the point. It's a practice score that it's there to confuse. There's nobody to use it. So you do need. But if you have some established, let's say you have a student loan and a car loan you're making payments on every month, but you don't have that open credit card and you're trying to boost your score to buy a house, then you don't need 6 months of the credit card reporting. You might only need 1 or 2, but you've got to get cake and you got to get the flour in the bowl. The point is like if you're building with just installment loans, car loans and home loans and student loans, you only get credit when you're paying those. When you quit paying, when you make your very last student loan payment or car payment, your score drops because it can't score it anymore. It needs something to score monthly. That's why you want the credit card in there. So it's just, you got to have that mix of accounts to move forward. So it's still enough time. Right now, it'd still be enough time if you jumped on it right now to have a score by June, July.
How about department stores like Macy's and Sears and things like that?
Yeah, you can. You can apply for those. Those tend to be a little bit easier to get credit for. But I will tell you, it's not my favorite. Any kind of account like that is going to probably be a very low limit. It's very hard to work in a $20 system for it to be the payment method for something. If you do have that store card right now, don't close it. But it might be just something to where you have to put a reminder on your phone and get a $20 Macy's card, once every couple months, just to have that $20 activity so they don't close the account. It takes a little bit more energy to kind of keep that relationship going on a store card, because it's a little harder to get over there and charge, and use it in a system monthly that's going to benefit you and not put you in debt. It's very easy for you to max out on those cards. If you think about it, you go into Victoria's Secret, you have a $300 limit. I'm walking out of there with at least $100 worth of stuff. So I just spent a third of my allowance. Unless I go into the parking lot and pay it off immediately, they could report my balance tomorrow. And then that would ruin my credit score for the next month. It really does make a big deal. It makes a bigger deal if you have a charge-off or a collection that has reported in the last 24 months. Then you have no allowance. I mean, it's like you have to keep it right at 20 just to get your score boosted back up again.
So inquiries, I know there's a couple different types of inquiries. So for people that are trying to establish credit, isn't it important that they do this slowly? I mean, you don't want to all of a sudden sit down on the computer one day, and a lot of times you're getting offers in the mail, and you may get something from American Express or Capital One or Discover Card, and then sometimes people may sit down and apply all at once for these cards. sort of like a process. So you say Discover card,
Yeah.
because I want people to understand that every time that they apply, even if they're denied, they don't actually get a card, that actually goes against their score, right?
No. So
Okay.
that is the thing, is that soft inquiries are very well known now as being, they put it all over all the different websites. Like, you can see if you're pre-approved without it being a hard inquiry. Now, you have
Okay.
to understand, if you go forward with that company and you establish an account, it will then become a hard inquiry. Okay, but you're not getting denied and getting hurt for that. A lot of the credit consumer education websites really focus on inquiries. And that's because that's a big deal to the newer credit scores that we don't care about. So that emphasis on inquiries on the older FICO doesn't really matter. Like, for a mortgage, you can go shop several lenders in a 2-week time frame, and it's going to count as one inquiry, even if several lenders ran it. Same thing with a car loan. You could, I used to go down the street and they'd run my credit, they'd run my credit, they'd run my credit, by the end of the street, you were like, your score's dropped. But it's not that way anymore. They can run your credit several times until the account is actually like approved and established. Then it becomes a hard inquiry and an account is opened. But honestly, I've taken like 20 inquiries off people's credit before, and it's made a difference of maybe 1 point in their score. So it's less than 10% of the thing.
Yeah.
But you do want to be careful. You want to be strategic. You don't want to just go apply for everything. That's why I tell students, Discover. If you are somebody who has bad credit, you know that your scores are below the 550 place, and you need to get a credit card. You're not going to get approved at most places, even secured cards. Even secured cards. You would think in your head, if I'm putting the $200 up, why wouldn't I be approved? Because they still pick their customers. They still choose them. Where they don't is where I tell people to go, because I don't want you to be denied on step 1 of my getting you back to life. I don't want you being denied. So I send people to OpenSkyCC.com. This is a company I've sent, I'd say, thousands of people to, and I've maybe had 3 people I've ever heard say get denied. And that was because of an error within their system. They called the company and they got it all worked out. They have no credit check. They report to all 3 credit bureaus. I don't talk about anything I haven't tried myself, and it's worked beautifully. I will all day tell you who I don't like. Okay. You never call Credit One. I will just tell you, I don't care if they sue me. No Credit One. Okay. But Open Sky has a very good system. It's $200. You're going to put that deposit up. You're going to get that back eventually when you close the card, but that's all you need. No credit check. And in 30 days, they report your balance to the credit bureaus. And now you have something on your report that is essential to the mix of what makes up your accounts of your credit score. So Open Sky is the place to go. Self-lender barely ever denies anyone. Discover is going to approve you if you're 18 or if you have no credit. There's a big difference between having a bunch of bad credit versus 0 credit and nothing established. A lot more companies will work with you if you're nothing and we're your first shot, versus like you just charged off 100 cards. We're not giving you any money. That's why you have to go to Open Sky. They'll give you it.
So when you're dealing with like Discover, let's say they start you out, at a very low limit.
Yeah, always.
So maybe $500,
right?
Around there. At what point should someone try and get more?
It's about the accounts you have open available to you and what part of the allowance you're using. So if they increase the limit from 200 or from 500 to 1,000, where before you had kind of that, for a $500 limit, you had a $50 true limit. Now at $1,000 credit limit, you have $100. And what I mean by true limit, it means the amount you don't have to pay off by the end of the month, and you could carry into the next month and finance it a little bit versus paying it all off at once. If it otherwise, so it's not necessarily you need to increasing a credit limit. Having a lot of credit available to you doesn't matter as much as the amount you're borrowing against each individual card. It's the same way when people say you have to make a lot of money to buy a house. It's like, no, you just can't have a lot of debt that takes away your income because I've seen people be able to buy houses that were twice the amount of what other people that made a lot more money could buy, but they had so much debt, they have no income left to buy a house. So it's about what you're using, if that makes sense.
Sure.
Yeah.
Absolutely. So another way to boost your score would be to pay down your credit card debt or consolidate those credit card balances.
Yeah.
Can you talk a little bit about that?
The faster you can get those credit cards updated to a balance that's at $20 or under, the sooner the better. A lot of people say, should I slowly do this? Is it better for my score if I? No, the faster you get the recipe right, the faster we have cake. I mean, that's the way it's got to go. So the faster. So one thing that has worked for a lot of clients is that if they can get if all of their credit cards they have are pretty maxed out, they're not getting approved for an installment loan or like a personal consolidation loan, like one you could get at Lending Club or their bank or payoff.com. But this is an installment loan. It's just like a car loan, almost like 3 or 5 year loan that they give you the cash then you use and pay the credit cards to zero. You don't close the cards. Okay, so you're not closing the cards. You're just getting them back to zero. So you can get the 2 cards you've had open the longest on that $20 system. You find out what day they report. You charge $20 right before that. You pay it off right after, so that the credit cards are now working for you. You're not working for them. Now you have an installment loan reporting on your credit that just is all of the credit cards in one payment, paid monthly. And see, a lot of people get confused with it because they say, well, I don't want to do one of those personal loans because it's like an 18% or it could be 25%. Have you seen your credit card? Not have you seen your credit card. The credit card interest rate you pay it might even be a little bit lower. But the point is, how long are you going to be paying this interest for? You and I both know a 3% on a $300,000 mortgage is great. Over 30 years, do you know how much that is? Versus 18% on an amount over 3 years. What do you think? Who do you think pays more interest? Believe it or not, the 3%er, because they're paying it over a longer amount of time. So getting that 3-year loan, getting your credit cards paid off and a $20 balance reporting every month in 30 days. Most people I see in that 640 to 660 range pay everything on time, but the cards are maxed out, jump up into the 740 range in 30 days. As soon as the credit cards are back at that $20 balance, they've got one payment. They're not renting their debt anymore. It's got an end date. You're not just every month you make those minimum payments, you're going to notice, you're kind of like throwing money in the air. You might not even be tackling a dime of that principal each month. It might just all be going to interest. So you got to get it out of the rent-a-center way and get it onto the fixed payment every month that has an end date.
Yeah, I heard you tell a story about someone I think you went to high school with, and they wanted to buy a house, and I think they had like $16,000. Their credit cards were maxed out.
Yeah,
maybe 16,000, and their credit score wasn't as high as it could be to really get the best interest rate, and you had them obtain an installment loan. Can you just kind of tell that story?
Yep. They were pretty much almost maxed out. They were making minimum payments and a little bit more, so they weren't quite at the limit, but they were hovering right there, which at that point, your scores are in that 640 to 660 range. That's just kind of where the formula is. I told them they were trying to get approved for a $400,000 house. And the most with their income, they could, with their credit score and everything, with their down payment, they could get to is like 300, right in that range. So by taking the 16,000, going and getting a installment loan I actually sent them to lendingclub.com, not LendingTree, that's different, lendingclub.com. They got a 3-year loan. The payment was, I think, $600 a month on the 18,000. And it was about what they were paying in minimum payments. But 30 days later, they take the money, they pay the credit cards down. They've got 2 reporting $20 only. Their scores go from 660 up to 740. And now the same house payment they were being quoted for the 300,000 is the same house payment now on the 400,000. And that opened up a lot more options to them on what was available. And now they have an end date. They don't have 8 credit cards they're trying to make payments on, hoping they don't make a 30-day late, never really tackling the principal because they're not even making the minimum interest on this minimum payment, just setting them back for years. And literally a little bit of maneuvering and getting them on a fixed rate loan. There's really not a con to it. There's no prepayment penalty with these loans. You'll probably end up getting qualified or pre-approved for another one 6 months after because your credit's so great. And you do have to remember, you're going to get tons of pre-approved offers and emails and all of these things for you. And then you will go and you'll go and see if you did qualify. And sometimes you're pretty shocked that you don't qualify. And you have to remember, credit scores are a snapshot in time. They change on a dime. So if this month you were an 800 credit score, and next month, for no reason, you didn't know, but you got a $16 medical collection for a Sonoran lab after you went and got your COVID test. And you like, what insurance covers that? What are you talking about? That particular collection would not show up in the score on a Vantage score, FICO 8, FICO 9, none of those. But the mortgage scores, a $16 collection like that would drop your score 100 points, just like that. And so overnight, you go from an 800 to a 700 and fall off your pedestal completely. I got to deal with all kinds of stuff then. It's like ego, it's everything. But
Yeah.
you have to remember, you can be completely denied this month, make a life-changing couple, different decisions, and in 30 days be approved for everybody and more. It really does. It really just depends on what is making up the content of that report.
Yeah. Tip 3 is understanding reporting times. And you've been saying this $20 thing, and I want you to get into that because, a lot of people don't realize, and I certainly didn't until I heard you say it, but because I pay off my credit cards every single month. There was a time when that wasn't the case. And, certainly, I've gone through those periods of time in my life where you just couldn't afford to pay it off that month. But most of the time I pay them off every single month, and I pay them off really on the same date, and not realizing that there is a date every single month that each credit card will report the balance to the reporting agencies. Yeah. And based on your balance at that time, that weighs in heavily on your score. So can you explain that?
Yeah, it's probably one of those things that, put me on the map, I would say, because even my wealthiest people who have 800 scores, when I bring this up to them, they stop in their tracks and they say, what are you talking about? And I say, I know you pay your credit cards off in full every month, but are you paying them off before they report? And they're like, the statement date, the due date. So here's the thing. There's a relationship between you and the credit card. You two understand that you're going to borrow and pay back to them. You have a due date. You have a statement closing date. You have a billing cycle, right? There's a whole nother relationship between the credit card company and the credit bureaus. Okay. That is the one you want to get in on. That's the one you have to understand when that is. And you have to build it into your schedule to know that they're going to be talking this week, that you need to go check the account online and make sure in their system, the balance is what you want them to report. Or they will report an amount that then you can't change for 30 days. You can't just call up the company and say, will you tell them on a different day? They don't do that. They don't do that. Most of them, each credit card, usually like Amex is one of those that says, we report your balance within 72 hours of your due date. Okay. Capital One or Open Sky is another one that they report your balance 3 days after the due date. So there's a couple of them like that, but you can call them up. Or the better thing is that you can actually access your credit reports right now, only until April, weekly, when you go to annualcreditreport.com. And we'll put that up. But when you go there, you're going to look like on the TransUnion report, under each of your credit cards, it'll say last date updated. And it'll say December 11th, 2020. And you mark over on your calendar on the 11th of the month is when Capital One reports my balance. So what I do is 3 days before to 3 days after, because at some months it's going to be the 11th, some months it'll be the 12th because of a holiday, things like that. So from 3 days before to 3 days after that reporting date, that's my no buy week. I call it buy week for football, but no buy week. You can't use the card. The beginning of the week, you check to make sure the balance is 20. You don't use the card for the week. The rest of the month, you can do what you want. Nobody's watching you. That week is sacred to your credit score. Okay. You understand? Like you can use those credit cards for paying this and paying that, even though I don't suggest it. You have to get into the mentality that credit cards are your way of demonstrating that you're good for it. Once you realize that, you'll never want to put anything on a credit card again. You'll go get an installment loan before, if you've got to spread something out over time to pay it back. But a credit card, there's nothing you're going to buy at Buckle or Victoria's Secret that's worth your future self not getting what they want. We take care of the inner child, but what about the future self? The future self's going, I want to go on a cruise. I want a big house. Like, don't screw me over today. So that's how you plan for that, is that you get that system in place 1 month and monitor it a few months.
So what's the importance of the $20 that you refer to?
Yeah.
So, like I pay my credit cards off. So if I paid them off the day before they reported, it would show zero balance on that reporting day. Why is having a $20 balance better than a zero balance?
Okay, so similar to the Pringles theory I was telling you, when they see a zero balance, you're much more likely to have the account closed or the limit reduced because of inactivity. They want to see you're playing. Okay, $20 is just enough. It's just enough to show, like a Pringle, that you're in the game regardless of the limit, because it's more than $1 and it's less than that, 10% mark. When I was first starting to teach this, you think about it, across the country, I've got a very universal, a very different audience, depending on where they're coming from. So to try to explain to people, you want to keep your balance at 10%. First of all, they already think I'm lying because they heard 30%. Number 2%, you lost me. And so I had to just come up with something that was like, what's the lowest credit limit out there? And at the time it was about 200. There's one other card I know of now that does $100 limit, believe it or not, in which then you're capped at $10. But I knew at $200, if I kept everybody on a $20 mark, the $200 kids would be great. The $300, really anybody else higher than that is going to be good. It just shows that you're playing the game, but that you are in total self-control. I have 10 cookies I could eat out of my cookie jar. I ate 1. It shows I have self-control like no other, and that's the fastest way you demonstrate that low risk, that you're worth it. Like I said, like that you're worth lending to.
Got it. So for people listening, that would mean that you would, if you didn't want to pay interest on the $20 that you would then be carrying over, you would have to go in after they report and pay the $20
always
to get your balance to zero.
Just get that system set up one time though, where you just have the $20 charge happen a few days before they report, and you pay it to zero a few days after. If you use the card at any other time of the month for points or whatever, you go and use it at the merchant, you go in your car, you turn your phone on and you pay it off.
And I know this might sound like a lot of work, guys, but what we're trying to do is get you the best interest rate on your mortgage. So this isn't like you have to worry about doing this. It's a one-time system. So once you get your mortgage and you lock in your rate, then you can start to just make sure you pay it off before it's due.
It's about being empowered. The point is that you have to take on this role of being CEO of your credit. If you aren't telling your credit cards what to do for you, you're working for them.
Yeah, you have to play the game. And let's talk for a minute about inactivity, because you had said something about when we had spoken before that, a lot of people think, well, it's great, I'm just going to keep these accounts open and I'm not going to use them. You had mentioned, was it after 6 months they stopped reporting?
After 6 months, they fall out of the mix. When there's been less than 6 months, when there's been more than 6 months specifically on the credit report, it'll say date of last activity. So activity, it's not about a balance reporting. It's about you utilize that card. When that date becomes more than 6 months ago, it falls out of the credit score mix. So there's times when I have somebody come in and they have a 678 FICO, and I look at all their credit cards and they're all at 0. And I look at, there's a doctor I had in a couple months ago for $1 million home, and he had a JCPenney card. And I said, you don't have any credit card balances. He goes, no, I don't use them. I said, that's the point. You got to use it, so you can show, like, this is how you practice and show. So I said, go to JCPenney this weekend. There's still one open. Go buy something for $20. And he looked at me like, you want me to go buy something at JCPenney for $20 this weekend? I said, yes, I do. And I need you to print me a statement. I'm going to send it in for rapid rescore. But he went from 678 up to 730. Okay. In 2 days as a lender, I can get it upgraded, fast. But by being able to go back to him on $1 million loan and say it's an $800 difference in your monthly payment now, $800, even those guys that are buying $1 million homes, they care. $800, they're like, you're it for life for me, lady. You know what I mean? It's like, who's going to teach you that? But yeah, that's a big deal. So utilizing those cards, you've got to do that. Not to mention that for any reason at all, these cards have the control and they can close the limit. They can shut the limit, bring it down. They can close out the card. They can do all kinds of stuff that will then hurt you because you're now when they close the account, especially when you still have a balance, that utilization is still being brought into your score. But the minute you make your very last payment, the account's closed. So it's going to drop your score. And you just paid off an account and you're like, woo, and it drops your score. So make sure you still have that open account reporting when you pay off your last closed account.
Gotcha. All right. So I have a little story to tell. Guys also know that once you're approved for your loan, as you get closer to the settlement date, they will check again to see what you're up to. And it can change. Mm-hmm. And Alisa will explain that it can change your eligibility to proceed with closing. What I hear loan officers say all the time is stop major purchases. You're buying a house. Don't buy a brand new car. Don't buy furniture for your house. Right. And so can you go over that?
Don't buy. The last one I had was a couple that went to the mall and bought a bulldog. And in the mall pet store, which you just don't do, and spent $4,800 and opened up a store credit. I'm like, oh my God. So you got a monthly payment of $180 that had to be factored into their debt ratio. Almost didn't make them qualify. What am I going to tell you to take a bulldog back? Never. So it didn't make it very easy. Here's the thing. Yes, stop the major purchases. Yes, talk to your lender. But here's another thing that a lot of people don't even realize. Okay. Don't go closing and paying off accounts before you go in to get pre-approved. A lot of times people want to refinance their car before they get pre-approved for a house, or they want to pay off their car so the car loan doesn't get factored into the debt ratio. Those things will drop your credit score right before you're going in to get your credit ran for a mortgage. So a lender for a car loan, I don't have to count the last 8 payments. As long as it's not a lease, I don't have to count those last 8 payments. So if you went in to go get pre-approved for the house when you had maybe like 4 payments left, then the lender doesn't have to count that payment in, and your score doesn't have to drop, where that is the score we're going to use for the mortgage. So it's some timing that's really super important. But you also don't, we're not going to pull your credit again, like right before closing. They used to do that years ago. But what they do is we have, all of the banks have a system in place to where it's monitoring your credit all the way to the day after closing. So it's looking all the way through to make sure no new credit was opened, that we're not factoring into the mix, that an account wasn't like that. Your credit cards didn't all of a sudden go up above 10% of where they started at. So you just want to really keep things steady and not make major purchases unless you talk to your lender and you verify with them that you can do that and that it won't affect you. You'd be surprised. Yeah.
So do you get alerted when their credit scores drop majorly before
at all. Settlement? After we pull your credit, Your credit scores are good for 120 days, as long as we close within that time frame. But so you can open another account. You can get a late payment. Okay. You can get and let's say you're going to close in 2 weeks and you just found out you went 30-day late on your car. You're okay. Believe it or not, you're okay. Because the lender will not find out about a late payment you made on an account right now. Not until it impacts your credit scores, which it'll take probably about 30 days before it shows up on your credit. But if you have to have your credit pulled within that time frame, you might want to have them pull it now. like, before they report that 30-day late. Be careful, especially right now too, before your credit card balances all update that you spent all this money at Christmas that you can't pay off. You might want to go check that out, but that's the
Pay
thing.
them down to $20.
Yes. Pay it down to 20 for best results.
Right. So guys, don't buy a car. You're buying a house. Wait until you've settled on this thing. You've gotten pre-qualified, locked in, closed, then go spend all your money.
Yeah. Don't forget to utilize that 401k too. A lot of people forget about it, but I don't have to count a 401k payment into your debt ratio. If you were able to take your 401k loan and pay off your credit cards or your installment loans that were preventing you from being able to qualify for a higher house payment, and now I have this payment over here with your 401k that I don't have to count into the debt ratio, not only is your score going to improve, but now your debt ratio just massively improved. And now we might be able to get you that house you want. It's all about being creative. Got a MacGyver.
So Alisa, how about people with derogatory marks on their credit?
Sure. So it's all about how recent they are, because if somebody had a late on their, like on a car loan or something that was 2 years ago, or a student loan, after 24 months, that stuff really isn't impacting the score anymore. A lot of people think that the medical collections can be completely ignored. They're not ignored in your FICO score. They're ignored in a lot of Vantage scores and more of the recent versions of FICO. They're not ignored in mortgage scores. So even though if your score's high enough to get qualified for a home, you get past that point, as a lender, I don't have to make you even look at the medical collections at that point. I don't have to make you pay them. Okay. I don't have to make you touch a charge off. Believe it or not, if you've got a repo, you got a charge off list on your credit, I don't have to make you touch it. But if it's impacting the score that's going to get you in the door, then we got a problem. If we can get you in, bump up your score by paying credit cards down, by doing other things, then once you get in the door, the medical collections and charge-offs don't have to be looked at. Collections don't have to be paid off. We have to use a percentage of the collection as a payment in your debt ratio. The only thing that's really going to bite you is judgments. If the collection turned into a judgment where they sued you and they won and they got a judgment on you, those don't show up on your credit anymore. You won't know it. The lender won't know it until the underwriter gets it. And then when the underwriter gets it, they pull up a lien report and it'll say judgments, and all judgments have to be completely taken care of. So that is something that you, as a realtor, I can hear it now. How did you not know this? How did you not know? Believe me, ask your realtor, if you're even worried at all, you can say, make sure you guys do a judgment report check, because you can go look in your county records in most counties to see if it's online, a recorded document for your judgment, but you're going to need a satisfaction of judgment. So you're going to need to show that you satisfied it, or at least that I've had several this year that in Maricopa County, prior to 2013, it was a 5-year statute of limitations on these judgments. And I've had several people that the title company called the borrower and said, you have to pay off this judgment before closing. Come to find out, the judgments were done prior to 2013 and weren't renewed. So I was able to say, no, they don't. They weren't renewed. And they were able to throw them out after they talked to their legal team. I was like, oh, go ahead. Let me know what they think. They said, sure. So anyway, that does work. If you can prove that it's outside the statute of limitations, then you can get away from not having to pay it. It's expired.
You also say that if you have these marks on your credit report and they're not affecting your score, one of the ways that they will affect your score is if you pay them off.
Right.
Because it brings it to more of a current status. Is that true?
Right. It depends on exactly what kind of a debt it is. But yeah, if you have a collection out there that's updating on the credit report every month, that there's a balance still owed, then every month it looks like you're getting a new collection. That's keeping you in this bucket. So the minute you pay that collection, it's either going to start fading out, out of your score month over month until it hits 24 months and then it's out of the mix. Or if you can negotiate for the collection company to delete it, which is something that's fairly new in the last couple of years. A lot of the collection companies have been more willing to delete the account, remove it completely once you've paid it. They don't just do that, and they just don't do that on medical. A lot of people think that automatically happens on medical, and it doesn't. So if you ask them, they'll remove it. As long as that's the only negative thing you have and it's deleted, your score is going to go through the roof. It's like it never existed. But if there's still several other things that are late or collections that are reporting in the last 24 months, paying the collection might even drop your score a little bit. It's just not worth it to go down the report and just start paying everything. There's a system. There's a way to go about it. And you have to make sure that it's not just about to fall off your credit, or if it's not even allowed to be on there because it's reporting incorrectly. So it's just taking a second. My website does carry a lot of information for after you've printed the report, how you actually go through it and understand it and color it so that you have a better understanding of how to really take action.
So you're saying that if you do have derogatory marks, you can actually call the creditor and negotiate, hey, I'll pay this off if you take it off, remove it from my report?
Only collections, not the original creditor. So if it's somebody on your credit like Wells Fargo or Discover, the original creditor that you did have a good relationship with until you didn't, they don't delete. Best case scenario, they're going to update the account as a paid charge off. It doesn't matter if you settle for $1 or you pay the entire amount. It does not make a difference. What it does is it stops the bleeding. It stops them from being able to sell it to a collection company, and it will stop the bleeding. So your score is not necessarily going to go up, but it's not going to drop anymore. And it's not going to start, and it's not going to continue down that quicksand route. You can stop it. Collections, once they sell it to a collection company and collection companies show up representing the debt of the charged off company, okay, the charge off at that point will have already probably updated their balance to showing zero because they've sold it. And the debt can only be represented by one company on your credit for 7 years. So they'll sell it to a collection company. Maybe that company tries for a few years and they don't get anywhere. They sell it to another collection company on year 5, and then they report. Then you hire a credit repair company and you pay a lot of money to get it deleted, and you get it deleted. But year 7, they sell it to another collection company, and that company, they can do that for 7 years on that credit report, which is, very frustrating. But yeah, it's best off if you can get to the charge off while the balance is still reporting on your credit and settle with them. You just became your own debt buyer and you've stopped a long road of bleeding. So that's the best way if you can close out that charge off. But if you just go down a list and a charge off has a balance there, but it hasn't reported or like updated the balance since 2017, don't touch it. I know that it says it has a balance there, but it has faded out of your score. Any activity, you calling and paying it, will bring that 2017 date back to now and make it look like you just got a bad account. So that's one I would tell people, don't touch it. I won't make you touch it. It's not impacting your score. Let's move on. Same thing with medical. If it's not in the last 2 years and they haven't updated it, it's parked on your credit, but it's not being updated every month, don't touch it or you're going to hurt it. You're going to hurt your scores.
Yeah. And with credit card companies, people make mistakes and they're late, and sometimes they'll get a 1 times 30 days later, whatever, on their credit. If you call the credit card company, don't they give you like some type of leniency where they will remove it once every couple years? Is there
Depends. Every single company is a little different. My strategy is you start right when you find out you have the 30-day late, you call immediately. It has worked better with people that go online and talk to a live agent, like through the website. I've seen it happen so much faster when they get those 30-day lates removed. But you're just asking for, I made a 30-day late, it was a complete error.
Like a courtesy.
Can I get a courtesy removal? Can I get a goodwill removal? And most of the time they'll do that. Now, if they say no, I've had somebody call. Every company I've ever heard of does it. Okay, so it's not like there's some policy that they don't. But Amex, it took a girl 6 times calling them before they finally did. I've been on the phone with Capital One several times when customers have got, no, and then got on the phone with them and got them to say yeah. So, it's just a matter of how hard you push. And if that still doesn't work, make 6 payments on time. Use the account. A lot of people, the minute they get a 30-day late, they're so mad that they won't remove it. They quit using the card. They'll just quit using it. They'll leave it at 0. They might even close it. That's the worst. But don't close it. Still use it. Still use it like they're your best friends. And 6 months into that, you usually can call them and get that 30-day late removed then.
Great. Well, I think it's It's easy to see how important it is to have a great loan officer when you're looking to buy a house. And really, that's where you should begin. And great information, Alyssa. Thank you so much.
Oh, you bet. Thank you for putting this out there. I have so much respect for you. I love it.
Yeah, and guys, we will make sure that below whatever platform that you're either watching or listening to this podcast, that Alyssa's contact information is there, along with a lot of the links that she's referenced as well. So we really hope that you guys have enjoyed tonight's show and that this is a good inspiration for you to raise those credit scores before buying a home. I think you'll find it'll save you a lot of money. And we appreciate you watching or listening tonight, and see you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.